Hey, welcome to the Guaranteed Retirement Guy Show. So I want to talk to you about how much a $500,000 annuity will pay you. So what will $500,000 pay you if you put in, if you're looking for an annuity that will give you guaranteed income for life? A lot of people ask me, well, would it be better for me to do it as far as like immediate income, or maybe I should defer it for 3 or 4 years or longer? Which one would be better? And so we're going to look at both. We'll look at exactly what $500,000 will pay you right now for life if you were to take it immediately, versus if you were to take it, maybe 2, 3, 4 years from now. So, and we'll kind of play with the numbers here, but I wanted to share my screen and show you exactly how this works. And so you'll notice that I put in $500,000. I put age 60 years old, and the state, just for this example, is Florida. And I know 60 years old is, that is the age that a lot of people will think about retiring, just because their 401k allows them to take the money out, because, after you're 59 and a half, you're allowed to actually take the money out. But also any IRA account, any type of qualified account allows you to access it. And so that's when people start thinking about taking income. Now, for others, that might be way too early. But for this example, we'll just say, all right, let's say I'm single, okay, and I am a male, and I'm looking to have guaranteed income for the rest of my life, okay? They're going to pay me $36,000 a year. You can see right now, F&G is the highest one. Then they're followed by Sentinel Security. You get North American, you've got Allianz, and so forth, all the way down the list. And this is immediate income. So if I were to fund this with $500,000 and I took it right now, like next month, and let's say I took it for, 30 years, I'm going to take out roughly a little over $1 million in income. If I live longer, let's say I live till 100, then I'm going to take out like $1.4 million in income. So, but let's look at this a little bit more. Let's say I wanted to wait. Let's say I wanted to wait 5 years because I don't have insurance until 65, from Medicare. And so I'm thinking, all right, well, I need to work another 5 years because I want my employer to cover my insurance costs until I actually take Medicare. So if that's the case, then what you would do is you would fund the annuity now and you let it sit and you let it grow. And of course, that's going to give you $55,000. That's pretty good. $36,000 all the way to $55,000. That might be worth waiting for. And the reason why it's so high is just gives the insurance company more time. And when you give them more time and you defer the income, they are able to pass that on to you. And so also the income base of the actual annuity is allowed to grow as well. So if I go in here, just look at F&G's income base. I'm just curious what this looks like. Okay, so they're showing you, all right, so here's what the growth of the account will look like if it's tied to a decent index and it has this type of growth. Eventually, once you start taking the income, the account value does go down. But the income, of course, it keeps on going for the rest of your life. So, but here is what they actually use as far as income-based value for income, because you never know what your account value is. Your account value, what if the index does nothing? Okay, if the index does nothing, then your account value is going down because it's eaten away by fees, because they're charging you an income rider fee for this income. So you can see over here on the right, you can see those income rider fees. Those are the fees that they charge for that income, which in my opinion are well worth it if you're looking for a much higher ROI from your money as far as high income, because a lot of times the income will cut in half if you don't pay the rider fee. So, but I look at both. So it just depends on what you're looking for. But you can see at the end of the 5 years, if you take income at 65, now they're going to take $707,000, multiply it by 7.77, and give you guaranteed income of $55,000 per year for the rest of your life. So that's pretty good. And then you can see the numbers are the same. Down in the hypothetical, they're still multiplying 707,000 times 7.7. So that's just how they compute the numbers, regardless of what the account value is. And that's important to know, because if the index itself is not growing like it should, or we're in a bear market, then the actual account value is going to suffer a little bit. But if you're looking for guaranteed income, it doesn't matter, because the income base, that is what's important. And when that's worth over 700,000 guaranteed, and they're going to multiply it by 7.77, that's going to give you a lot of income. And so, yeah, if I were to take that out until I'm 89, I'm going to take out almost $1.4 million in income. And of course, if I live longer, I'm going to take out more. Okay, so that's if I'm single. All right, what if I am married? Let's just say apples to apples comparison. We'll have the same age. Okay, let's say my wife is also 60. Okay, so if she's 60 years old and I want to, let's say she's 60, I'm 60, and we want joint income, meaning if I pass away, let's say I pass away in my 80s, but she lives another 10 years. What if the account value is down to zero at that point? I can't pass any account value to her, but I certainly want the income to keep going, right? So let's look at that, and we'll see. It's obviously less because now the insurance company is on the hook for 2 lives, not 1. And in this case, it's showing you, all right, Sentinel Security, which is rated B++, they're the best one. But, you don't have to go with them. You could go with AIG, which is Corebridge, or you could do Athene. They're both A-rated, and they'll give you roughly the same amount, 48,000, 49,000 per year for the rest of your life and your spouse's life. Okay. So what if you're taking money from another account and you really don't need income at age 65? What if you can wait a few more years to, let's say, 67, or maybe you're waiting to take the maximum Social Security, or at least full Social Security benefit at age 67. Maybe you don't want to wait till 70 to get a little bit more, but you want to at least wait till 67 to get the full amount. So if you do that and you let your annuity that you purchased, at age 60, if you let that sit and defer and grow, especially let that income base grow over the next 7 years instead of 5 years, now you can see the income is not 49,000 joint income. It's now 59. So just waiting 2 more years. It's a big difference. It's a huge jump. So anyways, if this is something you want me to go over further with you, let me know. I mean, if it's a $500,000 annuity, if it's less, if it's more, let's talk about it. Really, when I look at income streams for my clients, I'm looking at your pension, I'm looking at your Social Security, and then we look at your assets, your 401k money, your IRA and brokerage money, and we'll look at that and say, all right, how much do we need to give you the income or cover the income gap that you're going to experience with, you might have Social Security and pension money, but maybe you need another $30,000 a year in income, and you want that to increase with inflation. Then we would look at some different annuity strategies that would give that to you. So, and again, typically what I do is I try to use the least amount of assets that I can for that, so we can at least get your guarantees covered. And then you leave the rest of the money wherever you want it. If you want to put more money in annuities, you certainly can. But what I like to do is at least kind of, let's see what we can do to actually bridge the gap from where your income is now and where you want it to be. And then we use the best annuity to solve for that. So anyways, hope you liked what you hear. Appreciate you watching. If you do want to book a call, go ahead and go to the link below this video and you will see a link to my calendar. Go ahead and book a call if you'd like to chat some more. See you in the next video.